All right, folks, welcome back. It's our Tuesday commentary for the ICT Mentorship, January 4th, 2022. All right, so we had just a little bit of follow through on the upside on the dollar index, still stuck in the range. It hasn't really moved yet, but nonetheless, a little bit of movement on today's price action. Took out short-term high in here. All right, buy side liquidity here. Swept deeper for this run in here into this imbalance there. Also notice the buy side imbalance, sell side inefficiency here. Consequent encroachment. So I measured this candle's high, this candle's low. Midpoint's right there. Hits it. Goes below it, I think maybe by 2 pipettes or something to that effect. Hits it and then reacts off of that as well. So turtle soup run on this high down to consequent encroachment and sell side liquidity. You can see that here on the 4th of January. Rally higher, break down, small little gap in here, fills that in, sells off, another gap here, second stage distribution, runs for the liquidity. So this is a sell model here. You can look at that on a 15, 5, and 1 minute chart for your own study. Euro-dollar daily chart. Again, consolidation. All right, I mentioned the sell side liquidity pool resting below here. That was tagged yesterday. Consolidated and rallied once more into this imbalance. Next pool liquidity is here, and then the old dealing range low. 15-minute time frame, euro. Sell side imbalance, buy side inefficiency. Buy side liquidity pool. Takes out the short-term low here. Rallies, fills it in. Just falls short of complete closure and rebalancing at that old low. Then displacement to the downside, rebalancing all of this. And again, sell side here, here, and the old low. Pound dollar. Again, keep your hands off this one. This one's being really fickle, but I'm looking for a complete run back up into the bearish order block here. So that might be a reclaimed bearish order block. British pound, dollar index, hourly chart. Buy side was up here, ran through that. After taking sell side out here, down into the order block and closure of the imbalance here. Optimal trade entry and another optimal trade entry here as well. So we had buy side imbalance, sell side inefficiency, rallies during the New York session to take buy side out here. You can see that here on a 15-minute time frame. Buy side here. Midnight Judas swing, we rally higher. Retrace going into the New York kill zone, 7 o'clock to 10 o'clock in the morning, New York local time. Consequent encroachment of the gap from this candle's high, this candle's low, right in here. Hits that with optimal trade entry using the bodies of the candles here. And here, you'll see optimal trade entry there with the New York kill zone. The rejection block here at 35.27, 30 pips above it at 35.57, runs right to that. And the teaching for today, just so you guys know, this is kind of going to be the pace of January's videos because I don't want to spend too much time harping on things that I'm not interested in personally, and I don't want to draw too much interest for you because I don't think you should be doing that. I'm mentoring you, so stick to what I'm showing and avoid the things I'm keeping your attention away from. All right, so the NASDAQ futures contract, upper left-hand corner. Now I have my chart set up as a 3-chart layout. Small section chart, another quarter panel down in the lower left-hand corner is another chart. Here is the hourly. So upper left is daily, lower left is hourly, and then the 5-minute chart on the right hand side is the largest of the time frames. Now, if you don't have a membership at TradingView that allows you to do this, it's not important. I'm just doing it so that way I can show everything in one thing, where usually I would show like a daily chart, then an hourly chart, and then a lower time frame chart. Don't feel like you have to have this, okay? It's not like it's a secret weapon, okay? But if you like to have this type of layout, I'm not certain which is the threshold you have to pay up to get this type of layout. I'm not sure, so forgive me in that respect because I don't remember what it was. I just had the professional level, and I just rebuilt me for like $600 for the year. So maybe that's something you're not interested in spending. It's certainly not needed, obviously, but you know, I'm showing it here to save time and also just to provide a way of looking at it that is, in my opinion, comprehensive. So on the daily chart, we have a rejection block here, highest up close candle in this swing high. That closing price extended out in time. That's this level here and this level here on the hourly. Now, from this candle's high, this candle's low, we have optimal trade entry, trades up into that. So we are in a premium when the market rallies up to here. We're in a market that is consolidating, and we're in January where it's going to go more likely sideways than it's going to do anything else. So if it's going to move back to a premium and a rejection block, and it does so here, then we start to break down ahead of the 8:30 to 11 o'clock window, which is what I was drawing your attention to again yesterday. The rejection block, we trade to it there. Does it repel? Yes. Do we have a swing low that's broken during the 8:30 to 11 o'clock hour? Yes. Now, from that point, you want to be looking at the relationships of the indices. In other words, what's the S&P? What's the Dow futures contract doing during the 8:30 to 11 o'clock time period? Is there a divergence here? Now, during the breakdown of this move here, the NASDAQ is showing an overwhelming weaker stance opposed to the Dow, which was obviously firmer, which I'll show you in a moment, and the mixed to flat level that would be seen in the S&P. Now, to get this chart, I failed to mention it earlier, I apologize. You can pull up N as in Nancy, Q, H, 2022, and you'll get this symbol here, okay? But we have a break-in market structure there going into the 8:30 to 11 o'clock hour or time window. NASDAQ showing a willingness to want to trade lower and post decidedly weaker price action. We can confirm later PD arrays with the divergence between the major averages, and I'll show you what I mean by that. This fair value gap here, before we see a slide of over 200 handles, notice the fair value gap in here. Yes, we've already moved lower, but I want to show you something, because this swing high here to that low, that's an optimal trade entry, and it's occurring during the time of day that we could be looking for setups. But how do you confirm that? If we go into the comparison between the Dow, which is what we're showing you here, this is plotting the high, and this is the S&P. Okay, so you can see a lower high, higher high. So right away, there's a divergence right there. At the same time, it's forming that fair value gap there. In the weaker of the two, or rather three, averages. So NASDAQ is already showing willingness to go lower. So you can confirm your fair value gaps with the same divergence that I teach you, looking across the spectrum of S&P, NASDAQ, and Dow. So you can confirm your fair value gap entry here, and over 200 handles moving lower. Now on the daily chart here, I have a volume imbalance highlighted as a discount array. So if we break lower and we take out this low, we can rebalance to this high here, but this old high is attached to a volume imbalance. See that? See at the close of this candle and the open of this candle? So there's no body in there, just a little tiny wick. So that volume imbalance is what's being shown over here. And the market trades right down into that at the 11 o'clock hour. How amazing is that? It's coincidence, I'm sure. So it trades down into that volume imbalance at the 11 o'clock hour, which is the closure of that time window that I'm teaching you to focus on as a operating schedule. Okay, you don't have to use the 7 o'clock to 10 o'clock in the morning New York kill zone. You can use this one here, which takes into account the 8:30 news, if there is any, all the way up to the 11 o'clock hour, which is right before New York lunch tends to kick in around the indices, and between 11 o'clock and 1 o'clock. That's usually a time window that I do not think any of you should be trading. Now, there are some yahoos out there that will think, oh, this is the best time in the world to do this and do that. I cut my teeth on these markets, folks. In the 90s, I learned a lot of lessons in losing trading during the lunch hours. Okay, you just don't do it. The sweet spot for morning session is 8:30 to 11 o'clock. That is it. That's why I taught it to you. This is the way it is. And again, in the afternoon, it's 2 o'clock to 4. Okay, and if you really want to be finicky about it, you can look at 1:30 to 4 if you really want to get early, but I prefer moves around 2 o'clock or after that sets up the PM trend. The morning trend tends to be more pure and pristine, and it'll offer a whole lot more excitement because everybody's trying to do the same thing, get involved in the day. Okay, and if you understand that the volatility is the highest at the open at that 9:30 window for stock indices or stocks in general, that excitement, that fever to be involved in something is going to drive and manipulate the markets a lot. So today's example in teaching was primarily just teaching the elements of still using the S&P divergence between the averages, the Dow, NASDAQ, and S&P, but comparing it with classic PD arrays. So we have a premium array here in the form of a fair value gap with optimal trade entry there. And we have divergence. Dow's going higher, S&P's failing to go higher, and we're already looking at the weakest indice, the NASDAQ. So notice how it's just been falling out of bed while the Dow is going higher, and the S&P just failed to make a higher high here. So that confirms that fair value gap right there. So you don't need to be in trying to catch the highs up here. Okay, you don't need to be doing that. You don't need to see a divergence here, like high, high, and then high, higher high, and then high, lower high. That's a divergence, yes. That sets the stage or the tone for this being a weaker of the three. But if you want to look for confirmation entries, you can wait for a short-term premium, optimal trade entry, fair value gap, bearish order block, the whole business is here. And then you have a divergence as well in the averages. And then over 200 handles delivered to a volume imbalance that's over here on the daily chart. So there's a lot of things here that offer more clarity and how you can still use the S&P divergence to confirm a move that's already begun, and you don't have to fear viewing this as chasing because you're looking for an opportunity to continue in an underlyingly weaker index, which is what's shown here in NASDAQ. So until I talk to you tomorrow, be safe.